A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. Credit risk. Banks' diminished credit assessments of other banks' solvency or ability to repay, such as occurred during the global financial crisis, GFC, is evidenced by rising interest rates in the interbank market, as the increased perception of risk carries the higher price of compensation as expressed by the interest rate. In this case, the central bank can lower the Fed funds rate to its target rate by lending needed reserves at its policy rate on demand, again setting rates and letting quantity adjust to demand. During the global financial crisis, the failure of Fed leadership to sufficiently understand that monetary operations and liquidity provision are a matter of setting price and letting quantity adjust to demand was initially evidenced when the Fed funds rate exceeded the Fed's target rate, a point highlighted by Lavoie, 2010. Footnote 4. In Lavoie's analysis of the corridor system, the derivation of the demand curve for reserves is more sophisticated than the Bank of England's approach upon which Figure 1 and Figure 2 above are based. In particular, he includes a third horizontal section at the target rate, which corresponds to the federal funds rate which is expected on the following days, before the end of the maintenance period. Lavoie, 2010. End footnote. The Fed's policy was to lend to its member banks only if they could provide U.S. Treasury securities as collateral. This policy resulted in the Fed funds rate rising above the Fed's target, as some banks needing reserves from the Fed did not have sufficient eligible collateral to access the required reserves. Mosler, 2016. In response to the observed rise of the Fed funds rate above target, the Fed began adding to the list of eligible collateral that allowed banks to borrow from the Fed at lower rates, which, when the list was finally sufficiently expanded, brought the Fed funds rate down to the Fed's target. Lavoie, 2010. Interestingly, in the week following the Lehman Brothers bankruptcy, after initially failing to provide sufficient reserves, the Fed overreacted, adding more reserves than were being demanded, as evidenced by the Fed funds rate falling below the Fed's target.